Welcome to Wall Street Unspun with your host, Peter Schiff.
But it's a giant bubble in search of a pin, and it's going to find one.
Are you confused with the ups and downs of the economy and what it means to you?
Don't believe the propaganda, and that's what it is. When you're listening to an analyst on a lot of these popular financial shows, you're not getting investment advice. You're getting propaganda.
Get ready to untangle the web of misinformation provided by the mainstream media.
These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stock.
And now, here's your host of Wall Street Unspun, the president of Euro Pacific Capital, and a licensed broker with a passion for truth. It's Wall Street Unspun with Peter Schiff.
Hi, everybody. It's Peter Schiff doing the entire show myself live from the office at my home in Westport. The number to call, 888-678-9597, 888-678-9597. I do the show, or try to do the show, live every Wednesday evening at 8 p.m. If I can't be here, somebody else usually is. 8 p.m. Pacific, Eastern Time, 5 p.m. Pacific, on my website, www.europac.net, and on shortwave radio, 5.07 megahertz. Well, I was actually supposed to skip the show tonight. I was supposed to be participating in a candidate forum in Newtown, Connecticut, with my two opponents in the Senate race here in Connecticut. But each of them backed out. I think one of the opponents backed out a week ago and the other one just yesterday. They both claimed scheduling conflicts, although we had this event scheduled a long time ago. So, you know, my guess is they just really didn't want to be on the podium with me. I know. I guess I can't blame them for that. I'm still in third place, and so I guess they don't necessarily see the upside in being seen next to me on a panel because I have no place to go but up, and then they would have no place to go but down. But there is a debate that I guess no one's going to back out of that will be on television. I think it's March 2nd, so it's coming up next week. It will be on a local Connecticut station. I think it's Channel 3 in Connecticut. I'm sure some people will tape it, and it will probably end up on YouTube, so people will ultimately be able to see that televised debate. But hopefully the debate will do a lot for my candidacy because for a lot of people in Connecticut, it'll be their first opportunity to even know that I'm in the race. You know, I happened to read a couple of articles written recently, one about Linda McMahon written by the Washington Post, and it was a lengthy article on her, maybe a couple thousand words. The reporter followed her around for an entire day, including a day that Linda McMahon, myself, and Rob Simmons all spoke at a Lincoln Club dinner. And the reporter wrote the story and spent a good part of the story covering the Lincoln Club dinner and Rob Simmons' speech and Linda's speech and all the interactions and the crowds and the things. And, it was an in-depth story about that event. The only thing was my name wasn't even mentioned. So, anybody reading this article, either they wouldn't even know that I was in the race, or if they knew I was in the race, they would assume that I wasn't even there at this event, which of course I was, and I spoke just like the other two people. There was another article that came out in a local newspaper today, that mentioned that if Rob Simmons dropped out, that Linda McMahon would have nobody to run against. Well, obviously, I'd still be in the race. So, there's still a lot of people pretending that I'm not running. But I think all that is going to change after the debates because I expect my poll numbers to increase. And also during the month of March is when our television commercials will be on the air and our direct mail pieces will be showing up in people's mailboxes. So I think a lot is going to happen during the month of March that really could change the dynamic of this race and really get me into the thick of it. And so I'm pretty optimistic on that. And for those of you who, would like to help out, certainly visit my campaign website, shiftforsenate.com. We have a lot of people who have volunteered on the site. We've got a lot of volunteers now active in Connecticut. We can certainly use more. The more, the better. So you can volunteer to help out on the Shift for Senate website. Also, donations. You can make donations. We're still looking to get more donations, especially when we start running these television ads. That's going to cost a lot of money. So we certainly need to continue to raise money to do that. So if you haven't donated or you want to donate some more, you can also do that at shiftforsenate.com. You can mail us a check. There is an address there on the Shift for Senate website for those of you who want to do that. Anyway, let me get into the show. Oh, before I do, I want to, try to interject a regulatory disclaimer. I know sometimes I do this at the end of the show, but I think I want to make a habit of doing it at the beginning of the show so I don't forget. But first of all, when it comes to investments, I don't give any specific investment advice on the show. I try to avoid that. I refer people who are interested in the specifics of the types of stocks to buy or the details of my strategy to call up and speak to one of the brokers at Euro Pacific Capital, which you can access at 800-727-7922, 800-727-7922. They can talk to you in more detail about the strategy, explain the risks, and give you an opportunity to determine whether what I'm talking about is right for you. But in general, I do talk about investment strategy in a broad sense. I talk about the markets. I talk about the dollar. I talk about precious metals, the U.S. economy, foreign economy. So in a broad scheme, I do speak about things that are pertinent to the way that you would handle your investments. And I certainly have a strong opinion on the way people should be investing. But number one, it's important to keep in mind that there are risks in every strategy, including my strategy. And obviously people who follow my investment advice, they could lose money, just like people could lose money following other people's investment advice. Nothing in life is certain, and there's risk in everything you do. There's risks in investing in U.S. stocks. There's risk in investing in foreign stocks. There's risk in investing in bonds. There's risk everywhere. So you have to understand what the risks are and determine for yourselves which risks you want to expose yourself to and which risks you want to try to protect yourself from. Also, when it comes to the show, I have a lot of opinions, and I'm not shy about offering them. And obviously, my opinions are my opinions. I can be completely wrong. Maybe the U.S. economy isn't in trouble. Maybe it's in great shape. Maybe Art Laffer was right. Maybe all the people in those Peter Schiff was right videos, maybe they're right and I'm wrong. Maybe Barack Obama is a great president. Maybe his stimulus plan is exactly what we need. Maybe Ben Bernanke is a fantastic Fed chairman. Maybe Alan Greenspan was too. It's possible that every single opinion I have is wrong. Maybe it's the guys at Merrill Lynch that are right. The fact that I may have gotten a few things right in the past could have all been just sheer dumb luck. Just keep all that in mind as you tune into this program and listen to whatever I have to say. As I said, it's all my opinion, and generally most of the things that I believe, most Wall Street firms, the conventional wisdom, most of your elected representatives, they all think I'm nuts anyway. So anyway, now that I've said that, let me go on with the show. And again, it's 888-678-9597, 888-678-9597 if you want to ask me any questions. And anyway, so Barack Obama was speaking on television today, and one of the things that he said in his speech is that we need to get the economy going. His plan is to get the economy going, and what he said he wanted to do was we need to stimulate demand. We need to stimulate demand. Well, no, we don't. Demand doesn't have to be stimulated. Everybody wants everything. What we have to stimulate is supply. We have to stimulate production. Part of the problem with the U.S. economy is we bought too much. We spent too much. We indulged our demands, even though we really didn't have the means to pay for all the things that we wanted. And Americans still want just as much as they wanted a couple of years ago. The problem is we've run out of credit. We spent too much money. The last thing we want is policies to stimulate demand, because the policies that stimulate demand are the ones that interfere with the ability to stimulate supply, to produce. So Barack Obama has it dead wrong. And in the very next sentence where he said we need to stimulate demand, he also said we need more credit. Well, the problem is credit comes from savings, and savings come from people not spending money. It comes from a reduction in demand, right? People decide not to buy something, and so they save, and their savings become credit. So the fact that President Obama says we need to stimulate demand and credit simultaneously, again, he's contradicting himself. He has no idea how economies grow, and he has no idea where credit comes from. I guess which makes him perfectly qualified to be the president of the United States and being the one who's in charge of theoretically solving our economic problems when the man is absolutely clueless about the basics of economics. And, of course, part of the problem is not only is President Obama clueless, but the people advising him are just as clueless. And so, obviously, we're not going to get sound policy. Speaking about the clueless, I was listening to part of the congressional testimony of Ben Bernanke today. And, again, a couple of things he even mentioned in his testimony, and, he says it, as if it's not even a big deal. One of the congressmen mentioned that he didn't think it was right that the Fed should force banks to write down the value of their loans simply because the value of the collateral has declined. And Ben Bernanke reminded him that they don't do that, they don't care about the value of the collateral. They don't force banks to write down the value of their loans regardless of what the collateral is worth, which is ridiculous. Why would they do something so stupid? I mean, obviously, if you loan somebody $500,000 to buy a house and the house is now only worth $300,000, to pretend that that loan is still worth $500,000 is absurd. And any bank that's doing that is obviously insolvent, and that's unfortunately what all the banks are doing. And then he also mentioned, with respect to refinancing, because one of the congressmen was talking about how it was hard to refinance, he reminded the congressman, well, Freddie and Fannie are guaranteeing refinances where the money borrowed exceeds the value of the house at 110 or 120% of loan to value. Now, instead of talking about the fact that they're doing that, he should be reminding everybody that they shouldn't be doing that. I mean, why is Fannie and Freddie doing that? That's a bailout for the lender. That means some other lender who loans somebody, let's say $400,000 to buy a house that's now only worth $350,000. When that guy takes that loan to Fannie and Freddie and refinances it, the original lender gets all his money back. Why should he? The loss is now transferred to the books of Freddie and Freddie, which means taxpayers have to pay for it. The whole thing absurd. But I'd say the most interesting takeaway that I got from Bernanke's testimony was when congressmen were asking him about what is he going to do. He's raising interest rates, and what is he going to do if that hurts the economy? If, higher rates slow the housing market, if higher rates, hurt the economy. And basically his answer is, well, I'm going to stop, or I'll cut rates back. I'm only going to raise rates as long as it doesn't hurt the economy, as long as it doesn't hurt the housing market. But the minute I see that there's any pain, well, then I'm going to go the other way. And that's, of course, the exact wrong thing to do. I mean, obviously, raising interest rates is going to be painful for a certain segment of the economy, namely people who borrowed a lot of money and who have, floating rate debt or adjustable rate debt. You can't abandon your tightening policy because it's causing some people some problems. I mean, weren't a lot of people having problems with high interest rates when Paul Volcker jacked them up to 20%? Of course they were, but he did it anyway. We can't have a Fed that says, well, I'm going to take the punch bowl away, but if I see anybody sobering up, I'm going to quickly spike it back up again and make sure everybody stays drunk. That's not what we want, but that's basically what he said, which is, exactly what we don't want in a Fed chairman. And it's exactly why, I continue to think, and I wrote about this in my, my newsletter that just came out today, that the real story is not taking place in Europe or taking place in Greece. The real problem is right here in the United States. We have got the more serious problem, and we're more likely to end up with the runaway inflation. I think that the European situation, the situation with Greece, is more likely to come, at least in the short run, to a better solution. Yes, Greece has borrowed a lot of money. Their debt to GDP is now about 110% of GDP. It's too high, and something needs to be done. Personally, I think that the most likely outcome is going to be some type of restructuring of Greek debt, some type of austerity, some type of big cuts in government spending in Greece to resolve the situation in a way that's very positive for the euro, because I don't think that there is going to be a bailout of Greece, and I don't think that holders of Greece debt are going to be made whole. I could be wrong, but I think that people who own Greece debt are going to take a hit, because I do think that the only real way that Greece can come to a reasonable solution to this problem is going to be through a combination of asking citizens to make sacrifices, but also asking creditors to make sacrifices in the form of accepting less than 100 cents on the dollar or 100 euros on the dollar based on what they've loaned. And you know what? That's perfectly all right with me, because the lenders are at fault. The lenders bought Greek debt knowing that the Greek government had all this debt. And, you know, if you lend a government too much money, you have to realize that that government might not pay you back. And that has to be a risk. People have to know that there is risk in sovereign debt so that interest rates reflect it. And I don't, you know, certainly to the extent that people bought Greek debt, I don't own any Greek debt, and none of my clients, to my knowledge, own any Greek debt. And the reason we didn't buy Greek debt is I thought it was too risky. I didn't think it was worth the extra yield. We do own some German government debt. And when we buy German government debt, we get a lower yield than the people who bought Greek government debt. Why is that? Well, because it's less risky, because Germany is more solvent than Greece. Why should people be able to buy Greek debt, get a higher yield, and then if there's a problem, get bailed out? And the people who buy the German debt end up suffering because they didn't get the higher yield, but they get stuck with the bailout money. So what we need is people to understand when they loan money, there's a risk they might not get it back, and they need to be more responsible. And to the extent that people realize that governments might default, then it will be harder for governments to borrow money, particularly governments that are already heavily in debt, which means if it's harder to borrow money, they can't do it. They'll have to cut spending instead. And ultimately, I think that is what's going to impact the United States, because once, you know, we kind of get behind the Greek problems and we have a resolution, then people will be focusing more on our inability to pay our debts. And, you know, one of the things that the market seems to be focusing on or trying to differentiate between the United States and Greece is they say, well, Greece can't print money, but America can, as if that's supposed to be a good thing. That's supposed to be a reason to take comfort in owning U.S. debt, knowing that the government won't default, they'll just print money. Well, that's just as bad. And in many cases, it's worse. I actually think that people who are holding Greek government debt will make out a lot better than people who are holding U.S. government debt. Because I don't expect the Greeks to give their creditors nothing, right? I don't expect Greece to say, we're going to pay zero, right? I don't even think that's within the realm of possibility. But what is more likely is some type of restructuring where they ask the creditors to take a 20% or a 25% haircut. You know, that's something that I think could happen. But that's not the same thing as getting wiped out, right? You're still getting something. And when you take into consideration the fact that people who own Greek debt over the past few years did get higher yields, so that offsets a little bit of the principal loss. But I think people that own U.S. government debt are going to fare a lot worse. I think, you know, people that own U.S. Treasuries will be lucky to walk away with 20 cents on the dollar or 10 cents on the dollar in terms of real money. Meaning if we go down the route of hyperinflation, if we just print money to pay off our creditors, and you're somebody that's in Europe and you've got the equivalent of, you know, €1 million in U.S. Treasuries, you know, by the time the dollar collapses because of all the money we print, you'd be lucky to get, you know, 500,000 euros, 50 cents on the dollar. You might only get 200,000 euros, you know. So I think that, you know, that a actual honest restructuring where, you know, you take a legitimate haircut, I think that's better for the creditors than being made whole in money of little value, so that you aren't really made whole in purchasing power. But I think the world is going to be paying more attention to the U.S. problems. And I know that, you know, it's easy to think, oh, you know, the dollar's rallied a bit. I mean, the dollar index is now back above 80. I think it's kind of, you know, in a very difficult area. I don't think the dollar, in my opinion, can really sustain for any length of time a move above 80. I think this is where money would be coming in to sell the dollar. And gold, to me, is still looking very, very strong. I think the chart still looks really good for gold. And I can't see a situation where you're having a strengthening dollar, or a big move up in gold where the dollar isn't also moving down. So my guess is that there's not a lot more upside for the dollar. I don't think there's much downside for gold. But I think that when people look at the dollar moving up, and they look at the problems in Europe and they think, aha, this is some kind of sign that the U.S. is okay, that our problems are really not that bad, that they're worse in Europe. I think that is a wrong assumption to make. I mean, certainly right now, when people are worried about problems in Europe, they buy the dollar by default, just because we benefit as issuing the reserve currency. We benefit anytime anybody is worried about anything. It's almost like a reflexive move into the dollar. And despite the fact that our problems might actually be worse, people don't realize they're jumping out of the frying pan into the fire because maybe they don't feel the heat, but at some point they will. And when the world wakes up, they will not continue to make this foolish trade. Nobody knows exactly when that day of awakening is going to happen. Right? Nobody knows when somebody says the emperor has no clothes, but we know that somebody will say it because the emperor is stark naked, and it doesn't take much to expose that. And so I want to try to use any kind of temporary strength in the dollar, and I believe any strength is temporary. To continue to move out of dollar assets and trying to accumulate pullbacks in the euro or in other currencies that might be falling in sympathy with the euro. To just get a better position for our investments and our strategy. Ultimately, it's my hope that we can avoid the worst case scenario, that we won't actually have the hyperinflation scenario. I would much rather see a scenario where we restructure our debt honestly, because the bottom line is I don't think there's any way we can pay it. I mean, I think it's impossible for the United States to pay back the money that it's borrowed, and certainly, try to keep the commitments that have been made, based on Social Security or based on Medicare or other off-budget items, or the commitments we've made to Freddie and Fannie. It is physically impossible. The American taxpayer simply doesn't have the means to repay. So it's either default or inflation. That's all we got. And I think default is a far better option, or restructuring, where we're honest about our situation. And yeah, I certainly think our creditors are partially to blame. It takes two to tango. It's obvious to me that we can't pay back our debts. It should have been obvious to the people who are loaning us all this money. So to the extent that they're going to take some kind of hit, they deserve it, for buying all this stuff and not having a question our ability to repay. So everybody is going to have to take some kind of hit to do it right. But hopefully we will do it right and not continue to repeat the mistakes that we have been making. So far, with the speeches I've seen from Obama today, listening to our leaders are still completely clueless with regard to what we need to do. We're still, driving full speed towards the edge of a cliff. It doesn't mean that we won't hit the brakes in time. And maybe if I get to the Senate, or if I grab the steering wheel and can somehow, force a sharp turn, maybe we won't go over the edge. But as of now, we are heading straight for it. Anyway, let me go to the phones and start taking some of your calls. First up is going to be David in Washington. Go ahead, Dave.
Yes, Peter. I've been listening or reading at Mice's Frank Shostak. I don't know if you know him or not, but he writes for Mice. He's an Austrian economist. No. The money supply, according to him, and I think the stats bear it out, has been contracting the last 5 or 6 months because of the lack of banks' ability, or the lack of good enough creditors to. Yeah,
I don't, see how it's possible that money supply. I mean, the federal budget right now is $3.8 trillion, which is actually twice what it was 10 years ago. It's hard to believe that as big as the federal government was 10 years ago, it's now doubled in size. I mean, that is huge. Now, of course, the government is borrowing, almost half of that. The budget deficit is like 1.6 trillion, and we're collecting like 2.2 trillion or so in taxes. But all that money that's being borrowed, a lot of money is having to be created in order for the government to spend it, because they're not getting it in taxes. So when you're running these massive deficits, when you've got interest rates down at zero practically, and you've got the Federal Reserve now owning, $1.5 trillion worth of mortgages and continue, money supply has to be growing. It doesn't even make any sense to me to think that it's not.
Well, it grew massively initially when the Fed went out and printed all the, created that money out of thin air and bought all those toxic assets and ran their balance sheet up to $2.5 trillion. But right now, the reserves are sitting at over $1 trillion. So the banks are not lending. He's saying just in the last, the Fed hasn't been active according to their balance sheet. Now I don't know. They may be doing something.
Well, I think the banks are lending, though, but they're lending to the government. Maybe, those assets are there, but they're parked in treasuries. I mean, I don't know that they're in cash or if they're buying treasuries, in which case they are lending. They're lending to the government.
Yeah, I guess.
And the government is spending. We know that one of the other things that just happened recently is Social Security is now in the red. For years, Social Security was generating a cash surplus because the government was collecting more in Social Security taxes than it paid in benefits. That's already changed. It's now paying more in benefits than it collects in taxes. So now Social Security is a current drain. I mean, it's always been a future drain with these huge contingency liabilities, but now it's a drain right now. It's already in the red. We're already at the point where Bernie Madoff had to admit he had a Ponzi scheme because there's no longer enough money to cover the outflow. The jig is up on this one.
Well, yeah, I agree with all that, and the fact that with this kind of debt, they're going to pretty much have to inflate. But right now, without the Fed doing the actual lending, if they're trying to go through the traditional means through the banks right now, are just not lending to where they're increasing the money supply. So it'd be completely up to the Fed.
I don't know. I still see that there's, maybe it's taken a bit of a pause, but it'll shoot up. I mean, they're just doing nothing.
Well,
but
they've got
money.
all those reserves, and I think paying interest on the reserves is really kind of a joke because they're not paying any kind of interest. But so you don't.
All right. Well, thanks.
That,
thanks for the call. Well, keep an eye on those statistics, and who knows what M3 is, because they don't report that anymore.
Right.
But all right. Well, thanks for the call. But also I wanted to mention too a statistic I just noticed. I brought up at one of my political speeches, and I saw it on the Cato. I think they did a study that government workers now, the average government worker is earning almost 60% more than the average private sector worker. And if you count the benefits, it's almost double. I couldn't even believe that. I mean, these guys are supposed to be civil servants. They're supposed to be working for us, yet they're out earning us 2 to 1. And I know there was a time in American history, I don't know the exact date, I'm trying to look that up, but when government workers earned less than private sector workers, and that was part of the idea behind, taking a civil service job at the government is that, you didn't earn as much as people in the private sector. And that was, part of the sacrifice to do, good work for the public. But, the government is a gigantic growth industry. The government keeps growing no matter what. Everything else shrinks, yet the government grows because it's sucking all the resources out of the private sector. The reason the government is getting so big is it's taking out of the private sector. That's why the private sector is in so much trouble. That's why we're bleeding, is because the government is sucking all that blood out of us. It's like this giant cancer, and in order to grow, it has to feed off of the private sector, making it weaker and weaker and weaker until eventually it kills it. If the government gets big enough, right, if the cancer gets big enough, then it kills the host, and the host is the private economy. And, I know I mentioned this before, but this jobs bill is now apparently going to pass because some of the Republicans, including the newly elected Scott Brown, go figure there, right? He's actually turns out to be a rhino. He's voting for this stupid jobs bill that's not actually going to create any jobs. But, the thing is that the big centerpiece of this jobs bill is that if you hire somebody, then, for the first year, they hire them, you don't have to pay the 6% that you would have normally paid for FICA, but that you do have to pay it every year thereafter. I mean, there's no way that, 6% off is going to cause people who weren't going to hire anybody to go run out there and hire. I mean, you could think in your own life. Let's assume that you didn't need any new clothes. You didn't need a new suit. And a store came out and said, we're having a blowout 6% off sale. Come on, every suit in the store is 6% off. For 6% off, would you rush out to a store to buy a suit that you didn't even need because you can get it for 6% off? I doubt it. If it was 70% off, you might think, gee, I don't even need a suit, but for 70% off, I'll buy one anyway, right? So the only people who are going to hire people based on this 1 year 6% off sale is going to be people who are going to hire somebody anyway, right? Oh, I was going to hire somebody anyway. Okay, I can get a 6% off. Fine. I know the rules in supply and demand. If you reduce the price, you do increase the demand. So I suppose at the very margin, could a few jobs be created? Is it possible that somebody, who didn't hire somebody and now they're going to hire them? It's possible. Here's how that would have to be. Here's the only way that would work. Let's say I'm an employer and I want to hire somebody and I got an ad out and the most I'm willing to pay is $30,000 a year for this job. I've determined that if I have to pay more than $30,000, the numbers won't crunch. But $30,000 is what I'm willing to pay. And nobody will take the job. Nobody is willing to work for $30,000. The lowest anyone's willing to work is $31,000, right? Well, if that's the case, then maybe this bill will seal that deal. Maybe that extra benefit will be able to get the parties meeting. But I have a hard time believing in this economy with so many people unemployed that there's a job out there where a guy's offering $30,000 and no one will take it because they're holding out for $31,000. I have a feeling that if the guy really wants that job, he'll come down $1,000 and take it. So the only companies that will benefit from this bill, and there are some companies, are companies that have a lot of low-paying workers with a lot of turnover, where a lot of people quit or you fire a lot of people and you're constantly hiring new people, right? So these people are going to be able, these companies are going to be able to hire people for a lower cost than they otherwise would have hired them. But it's not going to create jobs. These are jobs that would have been created anyway, right? It's certainly going to be a tax cut for some of those businesses, and I'm all for tax cuts. But to say that this particular tax cut is going to create jobs, I don't think so. Because the big problem, of course, is the tax cut is not offset by spending cuts. So the tax cut, which will simply mean that there'll be bigger deficits. And bigger deficits destroy jobs because the government has to borrow money to pay the deficits, and now that money is no longer available for businesses to expand and create jobs. So the whole thing is just giving politicians the ability to say, I voted for a jobs bill, I'm creating jobs, when everything they're really doing is destroying jobs. And that's what we have to get to the bottom of. We have to repeal all the job-killing legislation that they've been passing, and we need real, meaningful, permanent tax cuts, not these little gimmicks. And, of course, the tax cuts have to be offset by spending cuts. Otherwise, it's all a joke, right? If the government just runs up the deficit to cut our taxes, they're not doing us any favors because now we got to pay the debt back with interest or they clobber us with inflation. Anyway, let me go to the next caller is Ross from Maryland.
Hello?
Go ahead, Ross.
Hey, you talk a lot about the importance of having a currency with intrinsic value, but I believe the problem with that is that it can cause a lot of inefficiency with regards to higher transaction costs. And I was just wondering what you thought about Milton Friedman's K% rule, where you essentially replace the Fed with a computer and just increase the money supply by constant percentage rate each year, irrespective of business cycles. Yeah,
I don't want to put, my faith into some kind of computer program. I still think that having real money with intrinsic value is better than trying to base an entire economy or monetary system on faith of something with no value. I mean, the whole idea is that, before we had money, we had barter. And people, if you were a shoemaker and you wanted to buy a table, you needed to find a guy that made tables who needed your shoes. And the whole idea is to find one commodity that we can use to trade for other commodities, and we'll call that money. And that became gold. But the key was that commodity still had to have some desirability on its own. It had to have some intrinsic value to make it work, right? And gold has intrinsic value. But you don't have to transact in gold. You can still use currency as long as it's backed by gold, as long as there's something that's giving it real value. Not just we're going to put our faith in this computer program, that no one ever monkeys with the program and no one ever changes it. So, I mean, it's always when you have a system based on faith and confidence, then it can always fall apart when the confidence goes away. At least if you have something real like gold. Now, obviously, there could come a problem if somebody figures out how to make gold. If you could just, if you could just make it artificially, then, that is the problem. But, it's been a long time and no one's come up with a way to do that. So for now, I think that's the best system we got, because every time we try to put our faith in some kind of political gimmick, it always gets corrupted. The politicians corrupted, and then it doesn't work.
Right. And also, just one quick question, since I'm such a huge Milton Friedman fan, I was wondering if you can expand on why he was wrong when he concluded that the Great Depression was caused by the Fed allowing the money supply to contract, because, this is Milton Friedman we're talking about here, not some Keynesian nut shop.
Yeah, well, I think that he got money wrong. I mean, one of the ways that Milton Friedman disagreed with the Austrians was on money. I mean, Milton Friedman believed that money supply should grow at a certain rate. I don't think Milton Friedman completely understood the benefits of falling prices. I mean, I think he was more of a fan that the Fed should try to keep prices stable by creating a little bit of inflation every year. And I don't agree with that. I mean, I agree with a lot of Milton Friedman's stuff, a lot of his stuff. But the only time I have a variance with Friedman is when he talks about money. And so I think he was wrong there. I think that the Fed was right to contract the money supply. The mistake was that they let the money supply expand too much, and that's why we had a boom. And the fact that they stepped on the brakes wasn't the wrong thing. I mean, they shouldn't have kept their foot on the gas, so that we would have, continued in the wrong direction. So, yes, one of the reasons that we had the downturn was that rates went up, but rates had to go up, and the sooner the better. The problem was they were kept too low for a number of years during the 1920s. That was the problem.
Okay. And just last really quick question. You talked about the possibility of hyperinflation, but doesn't that mean that the central bank doubles the monetary base like every 72 hours? And it's taken us however many years just to double. I think we've only doubled the monetary base once. I know, you disagree with Bernanke and all that, but I still don't think he's that crazy to, do what Zimbabwe is doing.
Yeah, remember, you've got a lot of components to it. It's also the demand. I mean, once nobody wants dollars and the currency and the velocity picks up because nobody will hold it, it's not like the quantity. But think about what's going to happen. You see, we've got this gigantic government right now that's spending $3.8 trillion a year, borrowing $1.6 trillion. It could be that the budget goes to $4 trillion, then $5 trillion, then $6 trillion. I mean, it's growing. I mean, it's just going on this trajectory. And when interest rates start to rise, which they inevitably must, the cost of financing that debt is going to rise astronomically. Right now, it only costs us $300 or $400 billion a year on interest because rates are practically nothing. But what happens if rates are 5 or 10%? And interest on the national debt is $1 trillion or $2 trillion a year. And imagine how much weaker the economy will be if interest rates are 10% or more. So the budget deficit's going to be bigger. So we can start having $3 or $4 trillion a year budget deficits. And if nobody wants to buy those bonds, who's going to buy them? Just the Federal Reserve. Now, the only way to avoid hyperinflation is going to be for the government to fess up to the American public and say, we've got to slash spending. We got to cut back on federal pay. We got to give everybody a pay cut. We got to cut all these entitlements. We got to cut back on pensions. If they don't have the guts to do that, then hyperinflation is all we're going to get. Yeah. I don't see how we avoid it unless the politicians do the right thing.
Mm-hmm. Yeah. Well, thanks a lot.
But if they do the right thing, we won't have hyperinflation. We will have high inflation before they do the right thing. But yes, our fate is not sealed. If I thought our fate was sealed, I wouldn't be running for the Senate. Right? It isn't too late to do the right thing, but one day it will be too late. And the longer we wait, the more likely it is that we'll go beyond the point of no return.
Mm-hmm. All right. Well, thanks a lot, Peter. Huge fan, and wishing you luck.
All right. Thanks for the call. Next up is Stephen in Pennsylvania.
Hi, Peter. I was
Hi.
just hoping you could. Yeah, could you just expand a little bit on your feelings about renting versus actually buying a home? I know you've talked about that a little bit. I've seen on interviews, and I'm just wondering if you can kind of just briefly give a quick synopsis as to why you think that's actually a preferable route for somebody to take.
Why do I think renting is preferable?
Yeah.
Well, it all depends on your situation. I mean, I was a renter for pretty much my entire life. I bought a house in the last few months, but I didn't do it for financial reasons. I didn't do it as an investment. In fact, I did it despite the fact that I thought the house was going to lose value after I purchased it. Same way that when I bought my boat, I knew that it was going to lose value, but I bought it anyway. I didn't buy it because I thought it was a shrewd financial maneuver. I bought it because I wanted it. And so at this point, real estate prices are no longer at the crazy levels that they were a few years ago. I mean, I know that I paid for my house less than it would cost me to build it based on the current construction costs. So, I'm not, I paid, I think, 40% less than the original owner who bought it brand new in 2002. So, I probably paid the equivalent of 1999, 2000 prices, 1998. So, I mean, obviously it's not, I didn't top tick the market by any means, but I think people have to look at their situation now. You still have to compare the cost of renting versus the cost of owning as far as what is the rent going to be? And, and you have to look at the other considerations. I mean, if you're a single guy, and you're in your 20s and you're not, why the hell would you want to buy anything? It makes no sense to me. I'd live in an apartment. It's a hell of a lot easier. It's, you have more, you can move if you want to. If you get a better job in another town, you can quickly leave. You don't have the property taxes. You don't have the maintenance headaches. You don't have to worry about depreciation because you don't own the thing. So for a lot of people, renting makes a lot more sense. I think that during the real estate bubble, a lot of people got suckered into buying because they thought they were throwing money away on renting. They thought they were an idiot to rent. They thought if they bought something that they would just make a lot of money, that it was, a ticket to Easy Street. So I think when people don't look at it that way anymore, they can make their own determination. Because look, obviously there are reasons to own a home, and that go beyond whether or not it's a good investment or not. It's just for some people, they want to have a place. They don't want to move every few years, or if it's an apartment, usually you can stay there as long as you want. But in the rental housing market, sometimes, landlords really, you can't rent for that long a time. Sometimes, you can only rent them for a year or two. And so some people don't want to move around. Some people do want to, remodel the house. They want to make it exactly the way they want. They want to paint it the way they want. They want, they want to remodel something. They want to do something to the landscaping. So there are reasons that people can want to buy a house, even though it might not be, financially the best thing to do. They're doing it for other reasons. But you got to look. I mean, there could be a situation where you can get a piece of property at a distressed level. I mean, you got to be. You might be able, if you can buy property for less than it costs you to build it in an area that you really want to stay in, and you can get it right now. One of the best reasons I can think of to buy is you can get an interest rate that's ridiculously low based on government subsidies and things like that. So if you can lock yourself in a 30-year fixed rate mortgage and you're getting a yield a payment under 6%. Ultimately, and if you're going to be there for a long time, it could end up being cheaper than renting because rents might go up over time if there's massive inflation. Although I think initially rents are still going to go down. I think that rents will be among the last prices to rise. I think food prices will rise first, energy prices, clothing prices, consumer electronic prices. I think landlords are going to have a difficult time raising rents when there's so many people who are unemployed and when there's so much vacant property out there. It's going to be difficult at first for landlords to really have any big rent increases. But you people do the math on their own. Look at the comparable costs. Look what's on. I mean, when I bought this house, there were still plenty of houses on the market to rent where it made much more sense financially. So if I was concerned about the cost, I would have just moved and rented something else. See, the thing to me was that at this point, buying the house was a relatively small thing for me. And even if the house lost another 20 or 30%, I didn't care. It wasn't going to affect my life one way or another. But if you are somebody who's in a situation where buying a house and watching it go down by 20 or 30% would bother you, then don't do it and just, go through the hassle of moving. It's not that big a deal, But as I said, it's different. I still think certain parts of the country, like in California, I still think prices out there are much too high. But there could be certain areas of the country where that's not the case. But the bubble has really not fully deflated, and of course, builders are still building homes. I mean, they haven't even stopped building yet. And one of the reasons they're still building is because the subsidies are still there to enable the buying. But eventually that's going to stop, and we're going to have a bigger supply and demand imbalance because the government intervened and had builders building new homes when they should have stopped years ago. But anyway, hopefully that answers your question.
Yeah, thanks, Peter. I appreciate it.
All right, thanks for the call. Next up is Alec in Kentucky.
Peter?
Yes.
I'm a big fan of yours, and I've contributed to your campaign.
Well, much appreciate that.
You're welcome. A couple of things I haven't heard you discuss that I think are important in the bubble and the meltdown. And one is the rating, giving AAA ratings to the trash CDOs. And the other is that Wall Street has all the money in the world to buy our congressman re-election. I'm wondering how you're going to avoid becoming another agent of the banksters.
Well, there's no way that's going to happen. I mean, I'm not going to the Senate to be bought out. If there was even the slightest chance of me doing that, I wouldn't even be running. And the chances of me running for re-election are pretty remote. So I don't see how they're going to get anything out of me. I mean, 1 6-year term is basically what I'm signing up for. I think that if I can't make a difference in 6 years, then it's too late. And if I can make a difference in 6 years, then there'll be no reason to stay. So, I don't see how I'm going to get corrupted. I mean, I think I'm going to be, the one person that is uncorruptible in that sense. And that's why I'm running. And that's why I have a hard time supporting any other candidate, because I don't have confidence in any other candidate. Because I know all politicians pretty much let us down because, that's their true colors. I mean, again, look at what happened with Scott Brown. So, I have confidence that I'm going to do the right thing. And so that's why I'm running, because I don't have confidence that anybody else will, and so why vote for somebody that I don't have confidence in? I'm going to do it myself. The first part of your question about the rating agencies, yeah, look, the rating agencies dropped the ball, right? They dropped the ball. They were in cahoots with Wall Street, and you would think they would care more about the reputation of their brand in the marketplace. But part of the problem is the government has licensed companies like Moody's and S&P, and they have a special privilege, right? Not everybody is allowed to rate bonds. The government has allowed them to do that. I would imagine that if the government didn't bless these few companies, if it was up to the total free market and anybody could rate a bond, so long as, then I think it wouldn't have happened, because I think there would have been a lot more concern about quality. But Moody's and Standard & Poor's, they know that the government is not going to license any other companies, and so they're still got like their quasi-monopoly on this market, and so there isn't the real free market forces that would have been in play. And in fact, I think this works a lot. I think there is an unspoken, and who knows, maybe it's spoken deal between the U.S. government and S&P and Moody's, and that is you keep a AAA rating on U.S. government debt, and we'll make sure that you get away with murder. We won't fine you or prosecute you for bad ratings, and we'll make sure that you don't have any competition. We'll keep it a small club of who we allow to rate securities. So that's kind of what I think is going on behind the scenes, and I think it's, again, it's a shame, but this is what happens when we get in bed with the government. It's just and I was on this radio show today, and again, this guy the host was saying something like, how can you have faith in the free markets? How could you think that the markets are going to regulate, the markets are going to do this? We need government to do it. And my reaction was, well, how can you have faith in politicians? You're telling me that a bunch of people who are in office, who know nothing, but all they care about is getting reelected, you're going to trust them to pass laws for our benefit? You're going to trust their political judgment when it's tainted, and biased? You're going to trust them over market forces, free market forces? I mean, people who want to put their faith in politicians, that makes no sense to me, because there is no historical basis for that ever working. I think there's a lot more reason to have faith in the market forces than in politicians doing the right thing for us.
But how can the markets work, though, when everything is so secretive and there's so many off-balance sheet problems,
Well, I think they're not working as well as they should because of all the government involvement, because of the Federal Reserve, because it prevents real signals from being communicated to the market. If we had real interest rates, if interest rates reflected true market dynamics, they would be much higher, and all of these bad debts and all these off-balance sheet items would be exposed much sooner. But because of all this government cheap money, it makes it a lot harder for people to understand what's really going on. And by the time it happens, it's like it comes out of the blue, and we're not prepared, and we get even more damage. So the key to allowing markets to function is to keep the government out of them as much as possible. And, when Barack Obama gave his speech, he's trying to pretend today. He was like trying to say, people who don't think I believe in the free market, I do. I'm a complete believer in capitalism. I think the government should have a very small and limited role. All that's a bunch of crap because he doesn't think that. He wants the government to have a huge role. He's out there saying he wants the government to have a small role. But, of course, then he said that it's important to have the government because only the government can do the big things, like build railroads. He forgets that it wasn't the government that built the railroads. It was private industry. It was the government that destroyed the railroads with high taxes and with what happened with the unions. But Barack Obama is trying to make believe that only the government can fund infrastructure. Believe me, private sector did a lot of infrastructure. The private sector built the subway system in New York City. The government didn't do that. The private sector will do things that are economical and viable. The government will do things that aren't viable at all because it doesn't care.
Well, Peter, you're one of the few people that I listen to on this subject that makes sense to me, so I wish you luck.
Well, thanks for listening.
Okay.
Okay, we got two more callers on hold, so let's make these the final two. Let's not take any more calls because I only have 8 minutes left. Next up is Jake in North Carolina.
Hi, Peter. How you doing?
I'm well. How are you?
I'm doing fine. Thanks a lot for taking my call. I actually have a real quick question. As far as silver goes, I certainly understand and agree with playing the long-term trends, and I think in the long run, silver is certainly a great investment. But I was just wondering if you had any idea or could shed a little bit of light on why over the last month or so silver dropped, roughly 15%, although it's on its way back up slowly, and gold kind of seemed to hold its own. I was wondering if there was some dynamic involved there.
Well, remember, nothing is a certainty, right? But I'm confident that gold and silver are going to go up. I think the reason that gold has held up better is that gold is more of a pure monetary metal, whereas silver is more of an industrial metal and a monetary metal. It's kind of both. And so, I think it doesn't have as much support. So when people are selling stocks and worried about the economy, they might also be worried about the industrial uses of silver. So there could be more selling pressure on silver. Whereas, yes, there is some jewelry demand, there for gold, but by and large, the majority of the demand for gold is coming from investors. And I think it's now coming from central banks as well. I think, central banks have gone from sellers of gold to buyers of gold. And I think that's a trend that's going to continue for a long time. I think central banks have a lot of gold to buy, which is one of the reasons I think the price is going much, much higher. And I also think individuals have a lot of gold to buy. I think the average individual doesn't own any gold. I own gold, and a lot of, people that listen to my show own gold, but we're in the minority. How many people, listen, I just was looking at my Facebook page. I have just almost 30,000 people on my Facebook page, but I looked at Dave Ramsey. He's got, over 300,000 people listening on his Facebook page. And Dave Ramsey says gold's a stupid investment, don't buy any. So the guy that's saying gold's a stupid investment, don't buy any, he's got 10 times as many people on his Facebook page as I have on mine. So my guess is that by the time gold is peaked out, there'll be more Facebook fans on Peter Schiff than Dave Ramsey.
Right. And do you expect the same type of trend to happen? Certainly there's a distinction between a monetary metal and just an industrial metal, but do you expect the same sort of trend to happen with silver as well?
Well, look, ultimately my bet is that silver is going to outpace gold as far as total return. So, when people ask me, what should I do with my precious metals money, I generally say they should have some gold and some silver, maybe 2/3 gold, 1/3 silver. I mean, I think silver is the riskier choice. So if the metals fall apart, right, I think you've got more downside in silver. But I also think if it's, a huge run up, that you've got more upside in silver. So it's always a trade-off. I mean, generally, wherever that when you get more upside, you have to, take a risk of more downside. It's just, so if I'm right, then I think you make more money in silver than gold. If I'm wrong, I think you lose more money in silver than gold. But you know what? I could be wrong on that too. So, you never know.
Okay, well, thank you very much. I appreciate it.
Thanks a lot. The last caller of the night, Jeremy in Florida.
Hey, Peter, how you doing?
Good. How are you?
Good. Thanks for taking my call. I just had a quick comment, but before I started, for those listeners out there who haven't heard your Hazlitt lecture on YouTube, I just wanted to point it out to everybody. It's one of the most insightful videos. I think I've seen it about a couple dozen times. And for you to kind of walk in there with no notes and apparently not even knowing the topic and then go on for about an hour and a half, I think is really amazing. I wish I had about a tenth of that public speaking ability.
Well, remember, I've been saying this stuff for years. I say it to my clients on the telephone. No matter what the topic is, I'm pretty much going to say what I'm going to say. So it's not really that difficult to do. But I thank you. It was a good lecture. I got a lot of laughs. It's on there. Some of the ones that I really like people to watch, I think the Henry Hazlitt lecture is one. I think people should watch my mortgage banker speech, which is now on one YouTube video, to really see what I was telling people in the mortgage industry about the housing market back in 2006. I mean, I think I totally hit every nail on the head when it came to what was going to happen in the housing market. So I think that's a great video for people to watch to really appreciate what I was saying and when I was saying it. Because the Hazlitt lecture came after the collapse. But it was just, I've got plenty of other, there's some of my money show appearances. There's a lot of video of me from 2005 or 2006, forecasts that have come true. So I think those are good to watch too. But I've given some good presentations. There's a long one up I did, I think, at Google that's up there on the internet, another hour presentation I did. And if you really want to watch some of these things, there's a guy that's putting all of my, I'm giving so many speeches now in my campaign, and they're all on YouTube. They're all up there. I mean, I'm usually they're shorter speeches, 10 to 20 minutes, and sometimes I take Q&A for 10 to 20 minutes, but they're all up there. So there's all kinds of stuff now you can watch a lot of stuff of me on YouTube.
Oh yeah, definitely. I see him the next morning after each one of your Republican conventions.
Yeah, the last one I did, I got a pretty good response. I changed up my stump speech a little bit, and I'm going to change a little bit more, but I got a pretty good response from the crowd at the last one I did, and I shortened it up that I did at West Hartford. That one, I actually put that as a favorite on my YouTube channel so people could take a look at it. But I think that I'm trying to find the best way to, to tell my story to these people. I think all the groups I've talked to, I think I've won a lot of support. So, but I just got to hone it down.
The reaction from all of them is amazing. I can't imagine you're not going to get, a majority of the support from the Republican Party in Connecticut. And it's a shame that the media is kind of drowning out like they are. But,
well, I think that'll change when I come up in the polls. Right now they just figure I'm low in the polls, and they figure it's just, I'm just a flash in the pan. Some people call me a vanity candidate. But that's fine. I like being the underdog. I think it's great. I fly under the radar right now. Everybody underestimates me, and then I end up, coming out and winning. I mean, I like the position that I'm in. I think it's better than being the favorite that everybody is sure is going to win. I mean, you remember, the last leg of the Triple Crown with Big Brown. He was going to win for sure. There's no way he couldn't win, and he came in dead last. Anyway, I hear the music. Thanks, everybody. Remember, don't forget, buy Crashproof 2.0 if you don't already own it. Visit the Europac website, www.europac.net, to learn more about the investment products and, of course, all the risks of investing at europac.net. And don't forget to travel, visit the Schiff for Senate site, shiftforsenate.com. Check out all my videos on my YouTube channel, Schiff Report. I'm posting quite a lot of videos there. Don't forget to visit. Anyway, I'm not sure if I'm going to be here again next Wednesday. Again, my schedule is full, but, they keep canceling on me. Sometimes it's the weather. Sometimes it's whatever. But if I'm here, I'll be here. If not, I'm sure I'll have a great host subbing in for me. Until next week, thanks, everybody, for tuning in. This has been Peter Schiff, Wall Street Unspun. Good night, everyone.